Just want to start by thanking you for joining us this evening for our webinar on cannabis business fundraising. I'm Akira Arroyo, Director of the Neighborhood Entrepreneur Law Project, commonly referred to as NELP, a project of the City Bar Justice Center. We're happy to have you joining us this evening for the second presentation in our three-part small business cannabis virtual presentation series. This series of three presentations is intended to provide equitable access to information about starting a cannabis-related business in New York City. Last week's session covered taxation of cannabis businesses and raised lots of interesting conversations and questions. And next week's presentation will cover commercial real estate and zoning. But tonight's program will dive into the legal considerations surrounding raising capital and banking issues as they affect cannabis-related businesses. Before I hand over the program to this evening's speaker, Marco Materazzi, I'd like to very briefly introduce NELP and the work that we do. NELP has been providing legal assistance to entrepreneurs of limited economic resources for well over 20 years now. And in that time, we've assisted over 20,000 entrepreneurs and small business owners and have worked with volunteer attorneys from over 100 different law firms and corporate in-house legal departments to deliver legal services to individuals who see entrepreneurship as a means of creating economic stability for their households and communities. In addition to presentations like today's, we offer online legal clinics that provide entrepreneurs and small business owners with the opportunity to have a free legal consultation with pro bono volunteer attorneys who can answer questions about your specific small business legal concerns. We typically provide free legal assistance with issues such as entity formation, contract drafting and review, and intellectual property rights protection, among many other issues, such as tonight's. If you're interested in learning more about our programming, you can go to our website at citybarjusticecenter.org to see what events we have coming up on our calendar. But before I turn it over once again, I just want to thank Alana Hans-Cohen, an associate at the law firm of Pashman Stein Walder Hayden PC and the chair of the New York City Bar Association's Drugs and the Law Committee. Alana and the other members of the committee have been instrumental in making this series of presentations happen and really have been so generous with their time and knowledge in this new and emerging industry, at least in New York State. So a big thank you to Alana and her fellow committee members. And of course, I want to absolutely thank our speaker tonight, Marco Materazzi, a shareholder and attorney with the Emerge Law Group, who will be presenting tonight on cannabis business related fundraising. Also a quick thank you to Duncan Delano, also of the Emerge Law Group and a member of the Drugs and Law Committee. Duncan is joining us this evening in the background to lend his voice on any regulatory issues or questions that may come up throughout the evening. Just a few items to note before I hand over the presentation to Marco. We will send a copy of the slides to everyone in attendance tonight. Those will go out via email tomorrow morning or tomorrow. And we ask that you please put your questions in the Q&A box, which should appear at the bottom of your screens. We'll try and break periodically to address questions throughout the program and also reserve some time towards the end for questions. So with that, Marco, I am pleased to introduce you and turn over the presentation. Marco Materazzi of the Emerge Law Group to speak on cannabis business fundraising. Thank you, Marco. It's all yours.
All right. Thank you very much. I hope you all can hear me okay. Yeah, I'll just give a brief introduction of my background before diving into the subject matter here. I am a corporate attorney. I've been practicing since 2005, focusing on advising business owners and investors in really all aspects of the business life cycle, with a lot of emphasis on capital raising, forming businesses, starting them up, growing them. I've been practicing in the cannabis industry since 2016. I'm based in Oregon, where, as you all know, I'm sure, the legal cannabis market got a head start on the East Coast. So I've kind of seen and been a part of the rollout of the legal adult use market here where I am on the West Coast for the better part of a decade. And I've been working in New York. I'm an attorney qualified in Oregon and also in New York for almost 2 years now with my partner, Duncan, who's on the line as well. And we work with a team of attorneys and paralegals here in New York and New Jersey, helping folks start their businesses, go through the licensing process, going through the capital raising process, which is what we'll focus on today. So we have a small, pretty small group here, and I wanted to, rather than just talk for the whole session, which that ends up if that ends up happening, that's just fine too. But to give the attendees a chance to let me know what they're hoping to get from this. In particular, if you're involved in the cannabis industry now as an entrepreneur, if you're actually trying to raise capital, or if you're considering getting into the market, that type of information could be helpful and help me kind of direct the presentation and speak to some of the issues that I think might be most relevant to you. So feel free to raise your hand if you'd like to speak, or you can also post something in the chat room or the Q&A, and I'll try to monitor that. We'll also break periodically through the slide presentation to give you guys a chance to ask questions. So I encourage you to don't be shy. The more interactive this is, I think probably the better it will be. Okay, so this talk is going to be focused on fundraising basics. Of course, we're talking about the cannabis industry, but the concepts that I'm going to cover today are, for the most part, almost every single one of them applicable to whatever industry you might be in as an entrepreneur or an investor involved with startup companies that are trying to raise capital. We will also talk a little bit about banking and the challenges that cannabis businesses face as compared to traditional businesses. Okay, so with respect to fundraising, the key themes that I'd like to cover today are here on this slide. One, and this will be kind of a repeated theme throughout, is the importance of matching your fundraising plan with your business plan. There are many types of investment structures and instruments, and it's very much not a one-size-fits-all situation. Depending on what your business plan is, what your investment needs are, what your story is of how you'd like your business to grow and develop, that's going to dictate what type of investment you should be looking for. Along those same lines, it's very important to be responsive to investor priorities. So I'll take some time to articulate what some of the common priorities are that investors have and how to address those. We'll also cover different types of investment structures, understanding the basics between the difference between equity and debt, what that means, And then within equity and debt, there are hybrid securities called convertible securities that are often used in the cannabis industry and in other startup businesses that we'll cover as well. And then finally, with respect to fundraising, I want to talk a little bit about securities law compliance and the importance of making sure you're aware that when you're raising capital, you are subject to the securities laws, and it's important that you comply with them. Okay, this slide, I think we pretty much already covered. Move on. Okay, so let's talk a little bit about debt versus equity. Debt financing is when a business borrows money from a lender and is obligated to pay the principal back, the amount loaned back at a certain time plus interest. Okay, taking out a loan, that's debt financing. An investor who provides debt financing or provides a loan is not an owner of the business. They're a creditor. Okay. Equity financing is when a business sells an equity stake in the business, a piece of the ownership of the business. Usually for a corporation, that's a share of stock in the company or multiple shares of stock. An investor, an equity investor, is not entitled to get repaid what they've invested, which is the key difference between an equity investor and a debt investor. But unlike a creditor who provides debt financing to the company, an equity investor does get to share in the upside, right? So if a startup business is worth nothing, when it starts, someone invests and takes let's say 25% ownership interest in the company. If that company then grows in value and is sold for $1 million, then that equity investor is entitled to 25% of that, right? $250,000. Where if the investor instead loaned money, let's say they loaned $100,000 to the company as a loan, they'll get that money paid back plus interest, but they're not entitled to a percentage of the value of the company. Yeah, that's important fundamentals to understand. Okay, so whether an investor is interested in being a creditor or an owner depends on their priorities, what they're looking for, their risk tolerance, and the kind of return they're looking for. If someone's looking for a set return on investment and wants to be more secure, then they're likely to want debt, right? That debt is an entitlement to be repaid over a certain period of time plus interest, right? And that interest rate is what motivates a debt investor to loan money to the company. The reason that debt is considered to be safer and more secure is because creditors have a priority of repayment. So if you loan money to the company and the company does not succeed, and there's a limited amount of money to be used to pay back investors, creditors, the ones who hold debt, are first in line. They are repaid. They have the right to be repaid before any of the equity owners, right? So investing in debt gives you more security, gives an investor more security. If, on the other hand, an investor is more interested in the growth potential of the business and wants to share in the increasing value of the company over time, which is often the case in the cannabis industry, right? There's a buzz around the industry. Folks think that many folks believe that that early entrants into the industry are going to be very valuable, and their businesses are going to increase in value, and the investors in those businesses are not interested in just a 5 or even a 10% interest rate. They want to get 5 times their money, or 10 or 20, and they think they can do that if they invest in exchange for equity ownership. Investors also often would like to have more of a say in the way the business is run, whether that be being part of the management team or just having the right to approve certain decisions. Although you can see those types of approval rights in both debt and equity structures, they're more common for equity ownership. A lender is usually a more passive investor. As long as they get paid their interest and their principal back, they don't really have any say in the way the business is run. Whereas an equity investor is more likely to require a seat on the board or regular updates on the progress of the company, and to have a say in this decision making related to the business. So we talked about what might be important to investors. It's also important to think about the priorities of the founders or the entrepreneurs, the ones who've started the business and who are seeking investment. Okay, and the type of investment that is raised will have different implications, right? So for some folks, it's important that their ownership percentage is not reduced, right? A company may need to raise a certain amount of money, but the investors don't want to give up any equity in the company, any ownership of the business, any of the upside. Okay, in that case, then debt will be the correct type of investment structure as opposed to equity. Similarly, many founders want to maintain control. They don't want to have more cooks in the kitchen telling them what they can and can't do. Okay. Protecting cash flow is another important priority that founders may have, right? And that means limiting the burden to make payments to anyone over time, but including investors. So if you borrow money, that often requires regular repayments of company funds, which takes away cash that could be spent on other things, investing in another location or more equipment or more employees or marketing. So that goal is met more easily with an equity investment. If you bring on an owner and they invest money, typically they're not entitled to regular payments, right? They get to share in the upside if and when there is one, but there isn't a burden on the business usually to make regular payments. Another investor priority that is relevant to the type of investment is the desire to have strategic partnerships. Right? Sometimes, a founder may want to maintain complete control and of all decision making and not give up any ownership of the business. But sometimes it's helpful to bring on partners, folks who not only are bringing money to the table, capital, but who also may have expertise in certain areas, may have connections or networks that are going to help the business succeed. In that case, giving up ownership to a strategic partner in exchange for dollars plus those other intangible benefits may make more sense. Okay, I'm going to pause right there before going into a couple of hypothetical cases where we can explore what type of investment structure may make sense given on the story or the business case. I know there's only 2 of you out there, but if you have any questions or want to make any comments, now would be a good time to do it.
If you raise your hands, I'm happy to unmute you and allow you to speak. So you don't actually have to type your questions into the chat. Oh, hand went up immediately. Thank you. Peter, here you go. Talking is permitted.
Looks like Peter is muted still.
Hello, can you hear me?
Yep, we got you.
Yeah, we can hear you.
So, yeah, great. I see this slide you got here telling me you need $200,000, just looking at the slide for cultivation, right? So we're looking to start up a retail dispensary. My question is, what is the capital, we're going to need or, projected capital for something like that in New York City?
That's a good question. And my answer to that is, I don't know. And it varies. This slide here is a hypothetical, is just a hypothetical, right? Assuming a business may need $200,000 under these circumstances, what makes sense from an investment perspective? Regarding how much capital is needed to start up a retail operation in New York City, Duncan, I don't know if you're in a position to chime in, but my intuition here, my sense is that it's a lot more than $200,000. That you'll probably need close to $1 million or more to be able to get a retail business up and running.
Okay. All right. I just want, approximate. I get that. All right. Thank you.
Thank you, Peter. And Duncan noted in the chat, for cannabis regulatory reasons, the amount of equity someone takes is limited to a certain percentage. So sometimes investors come in for both debt and equity.
Yeah. I will touch a little bit more on the fact that these categories that I've been talking about, debt and equity, as kind of 2 separate categories, and that certain factors and considerations often tend to lead one to a debt structure versus an equity structure. Those are generalities, and this is really a spectrum, and there can be debt that has features that's very much like equity, and there can be the equity that has features that's very much like debt. And there are many reasons, including regulatory reasons, that may also factor into using debt versus equity. So Duncan also replied here, cannabis retail startup costs could vary from 400,000 to 1 million in New York City. Mostly depends on the real estate and construction costs that are the lion's share of the capital requirements. Thanks, Duncan. Okay, so oops, jumped ahead here by accident. Okay, so I want to present kind of two hypothetical business cases, and then talk about what might make sense from a financing perspective to finance these two businesses. Okay, first one, business story one, is a small cultivation business that needs $200,000 of outside investment for startup expenses, to secure a lease, and to purchase equipment. The founder has put together projections, conservative projections, indicating that the company can be cash flow positive with a cushion for emergencies after this $200,000 outlay. The founder does not have any intention to raise further investment funds beyond this $200,000. Okay. That's business story number one. The second case, let's imagine a hypothetical manufacturing business that needs $200,000 immediately to secure the location and to get through the licensing project. Then the founder is anticipating that within 6 to 12 months, the business is going to need an additional $1 million to complete the build out of the facility, purchase equipment, make hires, and get to a place where it's cash flow positive. The founder is interested in reinvesting the profits that it makes to expand to additional locations and to scale the business and to increase value. Okay, so here are 4 different investment options, and let's see if we can match them to the business case. So the first one is borrowing $200,000 of debt financing at 10% interest, with the repayment required over 2 to 3 years. The second option is selling an ownership stake in the company for $200,000. The third is selling an ownership stake in the company for $1 million. And the fourth is selling a convertible note or a safe, and I'll explain what those are in a second, for $200,000 that then will automatically convert into an equity ownership at the time that the company raises more money. Okay, so these are 4 fairly typical investment structures that you might see in the cannabis space or any other industry for that matter. Okay, so going back to the first business story, okay, this founder needs $200,000 to get going and does not need any additional funds after that, and doesn't want to raise any additional funds after that. So there are really 2 options here that would make sense for this business. One is he could borrow the money, borrow $200,000. It has to repay it back and pay interest on that, but it wouldn't be giving up any ownership of the company, and it would satisfy its capital needs by doing that. The business could also sell an equity stake, an ownership stake in the company for $200,000 and give up a piece of ownership. The benefit to that is that there's no repayment obligation, doesn't have to make interest and principal payments over 2 to 3 years, and it can use that money instead as needed by the business. The downside is now that person is not going to be the 100% owner of the business anymore. They're going to need to share the value of the business with the equity investor beyond just repaying the $200,000 plus interest. The $200,000 investor, if they come in as an equity owner, will also likely want to have some decision-making authority, would like to have a seat at the table for key decisions, which would, maybe problematic for the founder. They may not like that. On the other hand, if it's someone that they trust and that they're happy to have as a partner, then this might be a good option for them. Okay, and I use that word partner. I think that's the first time I used it, but it's an important one. An equity owner is like a partner, right? If you give up ownership of your business, you're taking on a partner, and you're in a partnership with that person. That is fundamentally different than borrowing money from someone. Still important to make sure you're comfortable with your lender and have a good relationship with them. But taking equity dollars from someone means that they're in the business now with you. You do not get to just make all the decisions you want without regard to the interests of your partner, which means it's really, really important to be comfortable with whomever your investor may be. Investors, you often hear about the due diligence that investors will undertake on a business before investing money, making sure that they fully vet the business plan, making sure that they fully vet the founders and their background and their qualifications and their skills, which is true. If you're raising capital, you need to expect those types of questions and that type of investigation into your business and into yourself personally. What you often don't hear about is the company and the founder doing due diligence on the investor, which is also very important. Partnerships often fail. Businesses often don't work out the way that they intended. Businesses need to pivot. They need to change their plans. It's super unusual for a business plan to go 100% in accordance with plan without there being challenges and pivots and fights, which makes it really important to know and be comfortable with your investor, to ask for references, to hear from folks who have done business with the investor in the past, so you can try to get comfortable that this person is not going to make your life difficult and be an obstacle as opposed to an asset. Okay, getting a little sidetracked. The other two options on this slide are selling an equity ownership stake in the company for $1 million, or selling a convertible note or a safe for $200,000 that then automatically converts into equity at the time of the next capital raise. So these two options would make sense for this second business story, right? So here you have a founder who needs $200,000 now, and then they're going to need additional $1 million in 6 to 12 months. So by all means, if this founder finds a willing lender that's willing to invest $200,000 now on a conventional loan that needs to get repaid over time, then that very well be the option that they should take. But if they can find an investor who is willing to put in $200,000 now and then have that investment convert into equity in when the founder raises the next $1 million, then that might also make sense. So let me explain what a convertible security is. So a convertible security has features of both debt and equity. Okay, these instruments were invented as bridge loans, is what they're called. And the reason they're called bridge loans is they're intended to be a bridge to get the company through an initial period where it needs a relatively small amount of funding to the place where it's going to raise much more money. Okay, so in the example I gave here, in the manufacturing business, which is a more capital intensive business, more expensive machinery is required, there may be two phases of capital or more. And this may be common in retail as well, or cultivation, where before you can even get to the place where you need to raise the bulk of the money, whether it's $300, $400, $500, $600,000, where you need to get a property, you need to buy equipment, you may need some money just to get you there, right? To form a company, to hire attorneys or consultants to get you through the licensing process, to secure the license, and to be in a place where now it makes sense for you to borrow more money or take on equity investment, than to get to the next phase. So these convertible securities are basically designed for that. They're in these cases, the investor is not interested in just getting paid back what they've loaned plus interest. They want to share in the upside, but there's not going to be an upside unless you get through this first phase, right? So to get through that first phase, the additional dollars, in this case, in this example, $200,000, is structured as a loan, right? I, the investor, will loan the company $200,000, and the company needs to pay me back in a year, right? If before that time, the company raises more money, right, that additional $1 million it needs, then my $200,000 loan is automatically going to convert. It's going to switch into equity, into ownership. And the terms of that, the amount of equity that my $200,000 loan is going to get me, I'm going to get a better deal than the investor that came in 6 months later, right? So and that is to reward the early investor for the extra risk, right? If I loan the business $200,000 when it has nothing, just a founder and an idea, so yeah, I believe in you, take this $200,000, go get yourself a license, and then we'll work together to raise more money. And when we raise more money, I'll become an owner. So because of that extra risk I'm taking, my $200,000 is going to get me more equity than the per dollar than what the subsequent investors will get. Okay, so that's all covered in these bullet points here. You guys will get copies of this slide. So like I said, a convertible security is debt. It has a maturity date. It has an interest rate. So that early investor gets the protection and the security that I talked about earlier in the presentation, right? They have priority of repayment, right? A creditor is more secure, has priority rights for repayment than an equity investor, right? So if there is anything left in the company in a year, and the company doesn't succeed in raising more money, then I get that. I'm the creditor, that goes to me. But then if the company does succeed in raising the money, then my investment switches into an equity investment, and I get a percentage interest in the company. And there are features like discounts, conversion discounts, and valuation caps. I won't get into the details of those, but features that give that early investor, that reward that early investor for the extra risks they're taking, and gives them a better deal than the deal that the equity investor is getting. So I said that these convertible notes were traditionally used, and in fact were invented as a bridge to bridge that gap from when a relatively small amount of investment is needed to when a larger sum of investment is needed. That's what these were invented for, but they're used for all types of different things, especially in the cannabis industry, where there are regulatory restrictions and other restrictions that limit the types of folks who can own a business and how much equity they can own. Right. So I'm sure you guys are familiar with the social equity requirements of certain license types in New York. And, as a result of that, founders and their lawyers need to be creative in structuring the investments that come in, right? So New York says only a social equity applicant needs to own 51% or more of the business, but that business needs to raise $1 million or more. The investor who's putting that money in may require to have more than 51% ownership, or something that's like more than 51% ownership. So we can use convertible securities and other creative instruments to work within the regulatory framework, but give the investors certain rights that are similar to owning a higher stake in the company. Just pausing and encouraging anyone to chime in at any time. So getting a little bit more into the weeds with convertible securities, there are convertible notes, which is what I just described. And there are also, there are many types of convertible securities, but probably the two most common are convertible notes, which is, like I said, it's a loan. It's a promissory note that says, I, the company, promise to repay what you loan to me plus interest at this date. Right? So that's debt. It's a loan. And then it goes on to say, if this thing happens, and that thing is typically if the company raises more money, then instead of paying me back, my note will go away, and instead it will be exchanged with an ownership percentage in the company. Okay, that's a convertible note. A safe is a different type of convertible instrument that was developed by an organization called Y Combinator, based in Silicon Valley. And of course, Silicon Valley is the kind of hotbed for startup businesses, especially in the tech sector. And it's that industry based, centered in Silicon Valley, although there's obviously a lot of startup entrepreneurial activity also in the tech sector on the East Coast and elsewhere in the country and the world. But it's developed kind of standard documents that are intended to make the capital raising process faster, easier, and less expensive. Basically, it's a group that said, hey, we've developed this form of agreement. You don't need to hire a lawyer, just use this, okay? And the SAFE is similar to a convertible note, but it's not debt. There's no requirement of the company to ever repay the amount that was owed. Instead, it's a kind of hybrid between debt and equity that converts into equity when the company raises more money. And if the company never raises any additional money, then the holder of the SAFE is entitled to repayment in priority of the equity holders. Right, so it's a type of convertible security that is very popular. It's especially in the tech industry, but really all across all industries, all startup companies. It's become very popular. It's because it's a form document that is not intended to be changed. But there are downsides. It was created by institutional investors, and the terms are more favorable to the investors than the company. So it's, even though the idea is that you don't need to spend a lot of money on lawyers or other advisors, it is a good idea to use to hire a lawyer anytime you're raising funds for your business. So another concept I want to cover is
raising my hand.
oh, sorry, I didn't see it.
No worries. I just want, so what is the biggest difference again between the safes and the convertible notes? Is it simply that the safe is this form that's already out there? And
yeah, that's one difference, is that it's a standardized form that has kind of gained widespread acceptance in the industry, where convertible notes are also fairly standardized, but there's a wider range of types of convertible notes and features that you might see or not see in a convertible note. Even both of them are intended to be bridge financing, so they're intended to be used for the relatively smaller capital raise, where it doesn't make sense to be spending a lot of time and money negotiating detailed provisions, which is required when raising equity in a company. Typically, it's a much more involved process. There are many more rights that need to be negotiated, both management rights and economic rights. Convertible notes and safes are intended to punt that down the road. Let's punt it to when we're raising more money, and then we'll just, whatever you negotiate with those big investors, we'll just get those same rights. So the safe is that it's intended to be even more streamlined and faster than a convertible note. But there's also some important differences. A convertible note is a note. It is debt, right? When until it converts, it's the holder is a creditor of the company, where a safe is not. A safe is, it's kind of in this murky gray area between debt and equity, but it's considered equity for tax and accounting purposes. So there's never any right to repayment, and that is considered to be a good thing for companies, because if you issue convertible debt, and let's say the maturity date is 1 year, so it's, well, you either raise more money before 1 year and my note will convert, or if you haven't converted before by that time, then you got to pay me back. So that kind of is this this deadline that can create stress and problems. It essentially then gives the note holder almost a gun, right? That it can point to the head of the founder that says, all right, well, now you got to do things my way, or I'm going to bankrupt you. Whereas SAFE, that doesn't happen, right? The SAFE doesn't have a deadline to raise that equity.
Thank you.
That makes sense. Yeah.
I thought I did not hear that correctly. I thought I didn't read that correctly in your notes, which is why I appreciate the clarification.
Sure. Okay, so there's also a lot of nuance in the type of equity that a company may issue to an investor. Okay, so at its most basic, if you think of a company, let's say Duncan and I started a business, we own it 50-50, and we're going to raise some money. Someone's going to put in $500,000, and we're going to give them a third of the company. And now we're each going to own 1/3, 1/3, 1/3. Okay. Most simplistic form, say, okay, now we're each partners. We each have one vote in decisions of the company, and we split any, we split any profits of the company. Just 1/3, 1/3, 1/3. Okay. That's like the most basic, type of equity ownership that you can think of. That's very uncommon, okay? Maybe if you are working with your close friends or your family or your uncle, or your aunt or your cousin, they may be willing to do that kind of basic handshake deal. But usually investors, sophisticated investors who have invested before and will invest again, that is not the way they're going to invest. Even if they're equity investors, they're going to negotiate for rights that give them more protection, give them priority of repayment, and essentially reward them for the capital that they're putting in, right? In my example, Duncan and I may have been our idea. We may be the ones who are putting in the work, but we don't have the money. And for that $500,000, we're willing to say, okay, if you invest $500,000, we'll make sure you get that money back before we get anything. Okay, so that would be what's called a preferred return. And there can be all types of flavors of preferred returns. Essentially saying, you have priority. We'll any profit that comes from the company, you'll get it first before we get anything out, until you're repaid, and maybe until you're repaid plus some percentage return, 10%, 15%. Okay. But not only that, not only do you get paid first and a preferred return before we get paid, but if the company does well, then you get to have 1/3, right? So you get both things, right? You get priority of repayment, and you get to share in the upside in case we knock it out of the park and the company ends up selling for, $5 million. In that case, you're not just going to get your investment plus your preferred return back. You're going to get to take 1/3 of that. Okay. That's the economic side, right? So that's preferred equity. What Duncan and I have in my example is common equity. We just get our percentage share of whatever's left after the creditors are paid back and the preferred equity holders are paid back. If the investor is entitled to that kind of payment priority plus sharing in the residual value, that's what's called preferred equity. Okay? That's on the economic side. Equity investors also will negotiate on the management side. So ownership, and there's two types of rights that are associated with owning equity in a company. One is economic rights. Okay, how is the money shared, right? Which is what I just described. And the other is management. How are decisions made? Okay. And that first example I gave you, the super basic, it's just decision making is just based on ownership. If we each own 1/3, we each get one vote and majority rules. That's often the case, especially among founders, right? Among the partners who are starting the business. But investors often get more, right? So if in my example, the investor who invested $500,000 for 1/3 ownership of the company, they might negotiate and say, even though I only have a 1/3 say or 1/3 ownership and 1 out of 3 votes, you can't do any of these things without my approval, right? And that list can be really long, right? You can't borrow money. You can't issue ownership to anybody else. You can't spend more than $10,000 without my approval. You can't fire any senior management or hire any senior management with my approval. You can't enter into a lease without my approval. And the list goes on and on and on. So investors, equity investors, other than perhaps, your close friends and family, or folks who just don't know what they're doing, are going to negotiate for these types of rights. Okay. These negotiations can be lengthy, they can be time consuming, they can be expensive, which is another reason why these convertible securities were invented. It's to kick that can down the road, right? Going back to that business case number 2, right? I need $200,000 now just to get through the next hurdle of a license. Then the business is going to need $1 million. Okay, so let's wait. We don't need to negotiate all of these more complicated points with respect to economic rights and management rights. It's a waste of time. They're going to be totally irrelevant unless we get to this first hurdle. So let's just wait. And then when someone is ready to write $1 million check, you can bet that they're going to negotiate for those things. So the investor, the initial investor, will just piggyback and will just get those same rights that are negotiated by the bigger investor down the line. Hope that all makes sense. These are some complicated topics here. Let's see, what else do I got? So I touched on this already, that, not only, and this is really unique to the cannabis industry, I'll say, that, not only are we needing to structure equity investments to reflect the business priorities of the company's founders and the investors, right? And to get a meeting of the mind on the terms on which the investor is investing, what kind of economic rights they're getting, and what kind of management rights they're getting. In the cannabis industry, especially in New York and New Jersey, as opposed to some other states, like Oregon, there are regulatory restrictions that mean the business deal that the founders and the investors may have, they often come to us and they say, hey, this is our deal. And we say, well, sorry, that's not allowed. The investor can't have more than 49% or 30%, or depends on the particular deal. So now we have to use the investment tools that we have to see if we can come up with a structure that both satisfies the regulatory requirements, doesn't conflict with the regulatory requirements, but also gets close enough to the business deal to be satisfactory to the investor and the founders. That can be really challenging. It can be really time consuming and really expensive. So, I think if you find yourself in a situation where your business deal is, you can see that it's not going to work within the regulatory requirements, and that you're going to need to hire someone like me to come up with a creative structure. My advice to you is to do everything you can to not have to hire me to do that. It's expensive, it's risky, it's time consuming. It's good for me, but it's not good for you. Sometimes there's no alternative. Capital raising is really hard, right? Especially in the cannabis industry. It's not helpful that you have states like California and Oregon and Washington and Colorado where prices are super low and failure rate of cannabis businesses is super high. That doesn't help. It makes it hard to raise capital. Capital raising in any industry right now is hard. This is not a good economic environment for the capital markets. So folks have to be creative, and they have to do whatever they can to raise money. And of course, I understand that. My colleagues understand that, and we'll do what we can to help you. But it's not simple. Having to structure business deals around these regulatory requirements is really challenging. And then the last point on fundraising before we pivot and talk about banking briefly is probably the most important. I left it for the last slide, but I don't want it to feel like it's just a throwaway point, because it's not. So whenever a business is taking in money in exchange for a right to payment in the future, that is the offer and sale of a security. And the securities laws apply, right? Federally, the regulator is the SEC, and every state also has a securities regulator. Failure to comply with securities laws is very serious. You can get in trouble with the regulators. You can even go to jail if you're committing fraud. And you can also give investors a right to sue you and get their money back. So it's crucial that when startup companies are raising capital, that they do it in a way that complies with the securities laws and falls within an exemption to the requirement to register securities. Okay, so the basic premise is that every single offer and sale of a security requires that offer to be registered, both at the state level and with the SEC. What a registered securities offering is, that's an IPO. Okay, an IPO is not an option for a startup company that is just trying to get off the ground. So you need to fall within an exemption to registration. There are a lot of exemptions that exist, but the most common is what's called a private offering. Okay, and that requires you have to meet certain conditions to qualify as a private offering. And those conditions typically prohibit advertising or general solicitation of investment. So that means blasting on your social media that you're raising money. That's bad. If you do that, you've blown the most common exemption, and now you have to go down a different exemption, which is more burdensome and more expensive. Okay. Most exemptions also require, or the most typical exemptions also require, that the investor has enough money to invest, right? So the securities laws were developed to protect widows and orphans, right, from snake oil salesmen, right? So folks who are saying, hey, invest in my business, it's going to make you rich, and you know, taking money from folks who don't have enough money to invest, and then ripping them off. Okay, so over time, these exemptions have developed, and one of the backbones of the exemption is that investors that have enough money, they don't need the same protection as widows and orphans, right? So to qualify for these exemptions, investors need to meet certain wealth thresholds, right? The most common is called an accredited investor. To qualify as an accredited investor, you need to have annual income of $200,000 a year or net assets of $1 million. Okay? It's not that high of a threshold, relatively speaking. If your investors don't meet that, then you may not qualify for the exemption. And not only that, you know, even if the exemption is not an issue, general rule of thumb, what I tell my clients is that if your investor can't afford to lose the investment, then you should not take their money. Okay. And the reason for that is because if an investor loses their investment and now doesn't have the resources that they need to survive, they're much more likely to try to get that money back from you, to sue you, right? So both from a technical securities law compliance perspective, and also just from a common sense perspective, you really don't want to take, if you can avoid it, you don't want to take investment except from folks who can afford to lose it. I'll stop there with respect to securities law. Securities laws is a very extensive and in some ways complicated area. I could talk for hours about it, but I will just leave it at that for now.
So Marco,
And then, yeah.
Oh, I'm sorry. We do have one question
Great.
that was just raised, but potential issues related to creating GoFundMe pages to raise income.
Yeah, so there are different types of kind of crowdfunding portals or resources out there with different implications. So some of these portals are basically donations, right? That someone, you raise money and you're asking for folks to contribute to a cause or a business, but they don't get anything in return. They don't get an ownership stake in the business. In that case, it's not a securities. It's not a securities offering because the person who's putting in the money is not getting some kind of right to repayment or security in return. So there's no issue from a securities law perspective with respect to that type of using that type of a tool. Now, I don't think they're super successful in raising money for businesses. They're helpful for like helping people who have tragedies in their life, or you know, or worthy causes. But you know, at least in my experience, folks are usually less willing to try to give money to someone who's trying to use that money to create a profitable business without actually getting something in return. There are crowdfunding portals and tools that do give the investors a security, an ownership stake in the business. Those are highly regulated by federal and state securities laws. And there are many hoops that need to be jumped through in order to raise money using those tools in a way that's compliant. There are businesses that are set up to help founders do that, and they get paid handsomely. They take a big cut of the investment dollars that are raised, and there's no guarantee that they're going to be successful. So you know, we have clients that have successfully used crowdfunding tools to raise capital. Many more clients who have tried but have not been successful, and that comes at a cost. There's an upfront cost that you need to pay, and then even if you are successful, there are ongoing reporting and compliance requirements that you need to follow in order to be in compliance with securities laws. But it is a tool. I don't want to discount it. As I said earlier, it's hard to raise money now. It always is hard to raise money, but it's especially hard to raise money now. So, you know, crowdfunding tools should be considered as one of the options available to founders. Hope that helps.
Thank you. Any
Yeah.
follow-up to that? No, I think we answered the question. Thank you.
Okay. And then banking. I don't have any slides prepared for banking, but I'm happy to give a couple thoughts. I think banking is in the cannabis industry can be really specific to location. So Duncan and Brittany, even, who is also one of my colleagues at Emerge, may have some things to add here. Generally speaking, banking in the cannabis industry is really difficult. It's one of the big challenges. That and taxes are probably the two biggest challenges in the cannabis industry. And it's because this very unique legal gray area in which the cannabis industry operates, where it's legal on a state level and it's regulated on a state level, but it is still illegal on the federal level. Still a crime. Anyone who is participating in the cannabis industry is breaking the law, criminal law, at a federal level, even if it's allowed at the state level, which is really weird. It's unique. I can't think of anything else in history that's like that. The reason that that folks do it, even though they're breaking the law and could be prosecuted on a federal level, is because we all feel comfortable, based on both formal and informal messages that we've received from the federal government, that, hey, as long as you're complying with the state law, we're not going to prosecute you. We at the federal level is not going to prosecute you. Unfortunately, though, banks, for the most part, do not share that comfort level that I share, other lawyers share in the business, entrepreneurs in the industry. Banks who are regulated at the federal level are not willing, and in some cases not able, because of kind of technical banking requirements, to have customers that are either licensed cannabis businesses or even doing business with cannabis companies, including law firms. Our firm has had to switch banks several times, and many other cannabis lawyers have as well. So until federal law changes, either completely to deschedule marijuana completely, or to specifically address banking issues, there are going to be these banking challenges, in which, as with almost everything in cannabis, will require you to be creative and resourceful. There are generally two approaches to banking in cannabis. One is to work with one of the small handful of banks that openly and willingly does business with the cannabis industry. That usually comes with a cost, increased premiums and costs for bank accounts and other banking services, and time. It takes time to go through the process of opening an account. That's ideal, though. Any cannabis licensee should be trying to get a bank account with a bank that knows what the business does and is willing to bank with it. An alternative is to get an account with a bank that may shut you down. It's important not to lie to banks. If they ask you whether you're in the cannabis business or not, you should not lie, because if you do, then you could get in trouble for bank fraud. But sometimes a kind of don't ask, don't tell type of approach is common. So that's what I'll say about that. If anyone has any questions or wants to make any other comments about banking, please feel free.
I have a question. And so does
Yeah.
Peter. Actually, I'll let Peter go first. Go ahead, Peter.
Peter's still muted. I don't know if we need to unmute him or if he can do it himself.
He has to do it. Peter, I think you have to unmute yourself. I'm unable to do that.
Well, maybe you want other guys.
Can you hear me?
Yes.
Yeah, we can.
No? Oh, okay,
Yes.
great. Sorry, yeah. So in regards to banking, do you have any recommendations for banks? I mean, we have been looking at some banks, and what you said is true, is that the regular FDIC insured banks, they're not dealing with us. And we got,
Yeah.
a couple of banks that, we do have, but a lot of these banks, they say they deal with you, but however, it doesn't seem like they don't know anything about the cannabis business. So my question is, any recommendations of any kind of banks? That's all.
Yeah. Brittany or Duncan, do you have any names of banks in New York that are openly and willingly banking with cannabis businesses?
Yeah, we have there's a few. Dime Bank, there's like Credit One Credit Union, there's a few, and I think when we did this series last time, we provided a list to the folks at NELP to share with anyone who wanted to get a hold of that, a list of banks that are friendly to the cannabis industry. And yeah, I agree with Peter that some of them, even you got to understand what their process and fees are, because even ones who are on the list as supposedly being amenable to cannabis will, charge you a lot and treat you pretty poorly from a customer relations standpoint. So definitely shop around. But we'll provide a list to Akira and the other folks at NELP after the call, and then they'll make it available, and you can reach out, and that'll just be one of the resources that they have on hand.
Oh, terrific. Thank you.
Thank you. And actually, I was wondering if, Marco, you had any tips, or Duncan, if there were any tips for sort of finding out, or kind of how to do the research on with regards to finding banks that are friendly.
When finding our list is the biggest first step, and then reaching out to the contact people on that list. I think most of the ones have contact information, or it's you can find it easy enough. But it's usually a separate cannabis banking division or program, so you kind of got to get to the right people. But my tips are that opening an account is not like opening a business account. It'll take you up to 2 months sometimes to get a business account open for a cannabis bank account versus a non-cannabis business account. Yes, you can. So it's I would ask about their process and start the process early and shop around.
Thank you. And then we have another question in the Q&A. Engaging an attorney can be expensive, and if you're not sure which things you should handle yourself versus what you should engage an attorney on. When would you say are the important times that you should immediately consider engaging an attorney versus things to do on your own?
That is a really good question. And it's a tough one to answer, I think, in a kind of one size fits all type of answer. I think that let's see here. Certainly if you're taking investment dollars from an outside investor, that is something that you should consult an attorney about before doing it. I think that if you're forming a partnership with co-founders and starting a business, unless you have experience doing that, that's also something that you should consult with an attorney about. And I think, Duncan may speak more to this, but I think submitting a license application is also really important to get right, and is probably worth speaking to an attorney, or at least an experienced consultant or advisor before you do it.
Yeah, and I would just add to that really quickly that you should, after you've engaged an attorney, always have an open communication with them about what makes sense for the attorneys to handle versus you, because I think once there's a relationship established, it feels nice to just have your attorney do everything, but that gets expensive, and there's stuff you can do for that you don't need that expertise. And I'm gonna go now because my kids are screaming at me, but that's another tip for working with your attorney.
I think, thanks, Duncan. I think it's important too to have a relationship with an attorney that you trust, right? Like if you're working with me or Duncan or Brittany, we'll tell you if this is something that, yeah, go ahead, you can handle this, or no, you should let me look at that. So that's also important. So things like, signing a lease, a lease is a big deal. You should probably consult with an attorney before you do that. So anyway, those are a few examples.
We've got another question from Peter.
Go ahead.
No,
Peter.
no, actually, no, no, sorry,
Nope.
sorry. Let me lower my hand. I meant to lower my hand. Sorry. Never mind.
Thank you.
Great.
Any other questions? Oh, we have another. Yes, we have another question. You are free to talk, Selwyn. Just got to unmute yourself.
Do you hear me?
Yep.
Yeah,
Oh,
no, we can.
now. Oh,
Oh, not anymore.
Would we get a copy of that list of banks that are cannabis friendly?
we will pull that together
Okay, cool,
and
cool,
share.
cool,
Thank you.
cool, cool. Thank you.
All right. I think. Any other questions before we end this evening? Oh, one more. Is there a list of any cannabis investors? That'd be nice.
Yeah, that's tricky. There are cannabis funds, like professional investment firms that have raised money specifically to invest in the cannabis industry. And you know, there are lists of those that are around, and we can provide a list if you want, but those aren't going to be helpful for you. Those types of investment funds are not typically investing in startup cannabis businesses that are working on getting a license and opening a location, whether it be a retail or a cultivation or a processing or whatever. They're more interested in, at this point, in established businesses that are expanding, you know, across multi-state lines, or ancillary businesses that are serving the cannabis space but are not themselves actually touching the plant. So I think typically entrepreneurs are going to find success raising money from either within their network or through word of mouth, you know, speaking to folks who have been successful in raising money for their startups, going to industry events, networking. That's probably going to be a more effective way of raising capital than approaching some of the bigger fish, which you would find on lists and things like that.